Good morning and welcome to The Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Monday, August the 10th, 2026, and we have a packed show this morning. Wall Street just posted one of its best weeks of the year on the back of a deeply negative jobs report, and Wednesday's CPI could flip the script entirely. Let's get right into it. Lizzie, Wall Street threw a party after the economy lost 23,000 jobs last week. S&P up 3.58%, Nasdaq up over 5%. What's actually driving that reaction, and is it sustainable heading into this week?
Morning, Robert. The market's logic here is straightforward. A weak jobs number reduces the Fed's justification for another rate hike, and that means lower rates for longer, which is a direct tailwind for equities, particularly long-duration tech stocks where valuations are most sensitive to the discount rate. The S&P closed Friday at 7,757, the Nasdaq at 26,090, and the VIX dropped to 14.90, which tells you anxiety is genuinely fading. Whether it's sustainable is the real question, and the honest answer is that Wednesday's CPI will determine that entirely. If headline inflation surprises to the upside, everything from last week gets reevaluated very quickly.
Futures are mixed this morning. Nasdaq up 0.4%, but the Dow slipping slightly. Are markets just treading water ahead of Wednesday's CPI, or is there something else keeping bulls cautious?
It's mostly a wait-and-see posture ahead of CPI, but the Strait of Hormuz situation is adding a real layer of uncertainty on top of that. Brent crude is sitting near $84 a barrel, and Iran's conditions for reopening the strait remain unresolved. That waterway handles roughly one-fifth of global oil and LNG supply, so any escalation feeds directly into inflation expectations. If CPI surprises to the upside and oil stays elevated, traders would be looking at a scenario where the Fed not only holds but potentially hikes in September, which would hit rate-sensitive sectors like tech, small caps and real estate particularly hard.
Atlassian was up over 35% and Twilio nearly 25% on earnings last week. Are those moves telling us something broader about where money is rotating? Or are they one-off earnings plays?
Those are significant moves, but I'd read them as part of a broader signal that enterprise software with strong fundamentals is being rewarded when it delivers. It's not random. Salesforce was the top Dow performer on the same dynamic, and what's notable is that money appears to be rotating into software names with clear earnings visibility rather than chasing speculative growth. That actually sets up an important backdrop for this week, because CoreWeave, Nebius, and Supermicro Computer are all reporting. And they sit right at the centre of the AI infrastructure theme that Trump just reframed as a national security priority against China. Those reports will tell us whether the AI build-out spending is holding up in the actual numbers, or whether it's been more narrative than reality.
What about Tesla? Up 1% in pre-market to $332, driven largely by retail buying. Real recovery story or retail chasing momentum?
Tesla is still deeply underwater on a year-to-date basis, so I'd be cautious about calling it a recovery story just yet. The retail buying interest is real. You can see it in the flow data. But without a fundamental catalyst like a strong delivery report or a new product announcement, $332 is more of a sentiment bounce than a structural turn. Robinhood forming a golden cross for the first time since January 2024 is a technically notable setup worth monitoring. But in this macro environment, with CPI looming Wednesday, I'd want to see the broader tape stabilise before putting too much weight on individual momentum signals.
Steve, Wednesday's CPI is the number everyone is watching. What does a hot print versus a soft print actually mean for the September rate decision?
Robert, the stakes on Wednesday's July CPI release are genuinely high because it arrives against a backdrop where the most recent June reading came in at an index level of 333.95, which was actually below both the 334.7 forecast and the prior month's 335.12, suggesting some modest disinflationary progress had been made heading into this report. A soft July print that continues that trend would meaningfully reinforce the case for the Fed to hold in September, particularly after last Friday's payrolls shock already pushed the implied probability of a September hike down from around 50% into roughly 42%. A hot print, however, would force the market to price back in tightening risk, and given that oil prices remain elevated due to Hormuz uncertainty, that scenario is far from remote, which is exactly why bond markets and equity futures are both treading carefully right now.
What else are you watching from the data side for the rest of this week?
Thursday brings two important releases: PPI for July and the weekly initial jobless claims print, with claims forecast at 201,000 against last week's actual reading of 199,000, which itself came in better than the 202,000 consensus. What's notable is that claims remain historically low even as the payrolls report showed a dramatic loss of 23,000 jobs in July, and reconciling those two data points requires looking at labor force participation, which fell to 61.4%, a 5-year low, suggesting the unemployment rate ticked down to 4% partly because workers left the labor force rather than because hiring was genuinely strong. Friday then brings July retail sales, and with the personal savings rate having dropped sharply from 6.2% to 2.8%, that print will be a critical read on whether the American consumer still has the spending capacity to support the economy, even as borrowing costs remain elevated.
Lizzie, over to crypto. Bitcoin is stuck in that $60,000 to $65,000 range, even as BlackRock's IBIT pulled in nearly $700 million last week, the best ETF inflow week since April. Why isn't that capital translating into a breakout?
The ETF inflows are genuinely solid, but there are two structural headwinds absorbing that capital before it can push price higher. First, Strategy, formerly MicroStrategy, has been selling Bitcoin below its average acquisition cost of 75,418 tons, having recently sold over 5,000 BTC at around $63,957 per coin, just to cover dividend obligations on its preferred stock. And when the market's largest corporate Bitcoin holder is a net seller, that's meaningful supply pressure, regardless of ETF demand. Second, the Senate's failure to advance the Clarity Act before summer recess removed the key regulatory catalyst the market had been pricing in, particularly for institutional participants waiting on legal clarity. Bitcoin is sitting just below 65,000 right now and needs a convincing close above that level for a real breakout. The Fear and Greed Index at 40 tells you the market is in quiet absorption mode, not accumulation mode.
XRP is sitting right on that critical Monal support, down about 5% last week. Is there a tradable setup, or do you stay away?
XRP is the clearest casualty of the Clarity Act delay because its institutional adoption thesis depends directly on regulatory certainty. And without that, the ETF inflow picture has deteriorated sharply. XRP-linked funds attracted just $1 million last week, versus hundreds of millions flowing into Bitcoin and Ether products. Technically, a descending triangle pattern with an RSI near 34 is signaling bearish momentum, and some analysts are flagging a potential 35% decline towards $0.65 if that $1 level breaks cleanly. So that's a setup I'd approach with significant caution. On Ethereum, the picture is more constructive. ETH is range-bound between £1,140 and $1,950, and a break above $1,950 could set up a move toward the 200-day EMA near $2,050, with Ethereum ETFs seeing close to $200 million in inflows last week, which reflects institutional positioning ahead of the September Clarity Act hearing, and the staking yield now accessible through US ETFs continues to differentiate ETH as something beyond a purely speculative play.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions, and don't forget to subscribe so you never miss a morning. See you tomorrow.